EPK Capital presents Deep Dive on Morgan Stanley. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your AI host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Morgan Stanley. Picture this, a company that survived the 2008 financial crisis, dramatically transformed its business model, and emerged as one of Wall Street's most successful stories. That company is Morgan Stanley, and its journey from near collapse to consistent profitability is one of the most compelling transformation tales in modern finance. From investment banking powerhouse to wealth management giant, Morgan Stanley has reinvented itself while maintaining its position among the world's elite financial institutions. But here's what every investor really wants to know. After delivering a staggering 363% return over the past decade, is Morgan Stanley stock still a smart investment today? Whether you're attracted by the 2.4% dividend yield, intrigued by the wealth management boom, or betting on Wall Street's continued success, this comprehensive analysis will reveal everything you need to know about MS stock. Let's dive into the numbers, the strategy, and the potential that makes Morgan Stanley one of the most watched names on Wall Street. The company and its promoters, from crisis to triumph. Morgan Stanley's story begins in 1935 when Henry S. Morgan, grandson of J.P. Morgan, and Harold Stanley founded the company in response to the Glass-Steagall Act, which forced the separation of commercial and investment banking. What started as a small Wall Street partnership with just 13 employees has evolved into a global financial services powerhouse, operating in more than 40 countries with over 80,000 employees. The James Gorman era, a legacy of transformation. The most pivotal chapter in Morgan Stanley's modern history was written by James P. Gorman, who served as CEO from 2010 to 2023. When Gorman took the helm in January 2010, the global economy was still reeling from the financial crisis, and Morgan Stanley's future was uncertain. Under his leadership, the company not only survived, but thrived, more than tripling its stock price during his 14-year tenure. Gorman's strategic vision centered on transforming Morgan Stanley from a volatile, trading-focused investment bank into a more stable, diversified financial services firm. His masterstroke was the aggressive expansion into wealth management, including the acquisition of Smith Barney from Citigroup and later E*TRADE for $13 billion, the biggest bank acquisition since the 2008 crisis. New leadership, Ted Pick's vision. In January 2024, Ted Pick succeeded Gorman as CEO, inheriting a well-positioned company with clear strategic direction. Pick, a Morgan Stanley veteran with decades of experience across the firm's businesses, brings deep institutional knowledge and a commitment to continuing the firm's integrated approach. Business model. The three-pillar strategy. Morgan Stanley operates through three primary segments. 1. Wealth management, 48.5% of revenue, the crown jewel of the business, serving high-net-worth individuals and institutions with $7.9 trillion in client assets. This segment provides relatively stable, fee-based revenue streams. 2. Institutional securities, 42.6% of revenue. Traditional investment banking, including advisory services, underwriting, and sales and trading. This segment serves corporations, governments, and financial institutions. 3. Investment management, 9.9% of revenue. Asset management services for institutional and retail clients, operating with $1.6 trillion in assets under management. This diversified model has proven remarkably resilient, with the wealth management business providing stability, while institutional securities delivers growth during strong market conditions. 10-year financial analysis. The numbers tell a compelling story. Let's examine Morgan Stanley's financial transformation over the past decade, and these numbers demonstrate why it's considered one of Wall Street's success stories. Revenue growth, consistent and diversified. Morgan Stanley's revenue journey showcases impressive and sustainable growth. 2021, record revenue of $59.8 billion, up 23% year-over-year. 2024, strong revenue of $61.8 billion demonstrating resilience. Q1, 2025, record quarterly revenue of $17.7 billion, up 17% from prior year. The company has successfully diversified its revenue streams, with wealth management now contributing nearly half of total revenues, providing much more stable cash flows than the historically volatile trading operations. Profitability, margin excellence. Morgan Stanley's profitability metrics demonstrate the success of its transformation strategy. Return on tangible common equity, ROTCE, 18.8% for full year 2024, well above the company's 17% target. Expense efficiency ratio improved to 67% in 2024, showing strong cost discipline. Pre-tax margins by segment: O, institutional securities, 31% O, wealth management, 27% O, investment management, 17%. Net income reached $13.4 billion in 2024, representing strong earnings power and demonstrating the effectiveness of the firm's integrated business model. Balance sheet: conservative and strong. Morgan Stanley maintains excellent financial health, crucial for a financial services company. Total assets: $1.35 trillion as of Q2 2025. Common equity: $98.4 billion. Tangible common equity: $75.5 billion. Book value per share: $61.59. Tangible book value per share: $47.28. The firm maintains strong liquidity, with average liquidity resources of $363.4 billion, providing substantial flexibility for operations and growth investments. The conservative balance sheet reflects lessons learned from the 2008 crisis. Capital returns, rewarding shareholders. Morgan Stanley has consistently returned capital to shareholders. Dividends: current yield of 2.4%, with a track record of dividend increases. Share repurchases: active buyback program reducing share count over time. Payout ratio: approximately 45%, leaving room for dividend growth. The firm's strong capital generation capabilities support both growth investments and shareholder returns. Stock chart: technical analysis, a decade of wealth creation. Looking at Morgan Stanley's 10-year stock performance reveals one of the most impressive transformation stories on Wall Street: the remarkable journey. From September 2015 to September 2025, Morgan Stanley delivered a total return of 362.82%, turning every $10,000 investment into over $46,000. That represents an annualized return of 16.6%, significantly outperforming the S&P 500 and demonstrating the power of successful business transformation. Key technical levels. Based on our comprehensive price data analysis, all-time high, 157.76, reached in September 2025. All-time low, 21.16, reached in February 2016. Current price, 156.48, 52-week high, 157.76, 52-week low, $94.09. Current technical picture. As of our analysis, Morgan Stanley shows very strong technical fundamentals. Long-term bullish, price well above the 200-day moving average, $131. Short-term bullish, price significantly above the 50-day moving average, $144.91. Golden cross intact, 50-day average well above 200-day average, a strongly bullish signal, near all-time highs, currently trading just 0.8% below its all-time high. Strong momentum, 98.0% position in 52-week range. The stock shows healthy volatility at 33.1% annualized, typical for a financial services company, but well managed compared to historical levels. Performance patterns. Morgan Stanley has shown strong consistency with manageable volatility. Best year: +143.7% in 2021 during the post-COVID recovery. Worst year: 24.0% in 2018, financial sector sell-off. Recent performance: +25.4% year-to-date in 2025, +130.8% over the last 90 days. This performance demonstrates Morgan Stanley's ability to participate in bull markets while maintaining resilience during challenging periods. Benjamin Graham. Valuation. Is Morgan Stanley fairly valued? Let's apply Benjamin Graham's time-tested value investing principles to determine if Morgan Stanley represents good value at current prices. Graham number calculation. Using Benjamin Graham's classic intrinsic value formula, we get price of $116.18. Graham's assessment, potentially overvalued. At the current price of $156.48, Morgan Stanley appears to trade at a 35% premium to Graham's calculated intrinsic value, suggesting the stock may be overvalued by traditional value investing standards. Modern context and adjustments. However, Graham's original framework requires context for today's financial environment. P/E ratio, 17.7x. Reasonable for a quality financial services company. Price to book, 2.4x. Moderate premium reflecting quality and growth. Price to tangible book, 3.3x. Higher but justified by strong ROE contemporary value metrics. Looking at more nuanced valuation approaches. Price to earnings, 17.7x. Reasonable for current growth and quality. PEG ratio, 0.36. Attractive when accounting for expected growth. Price to sales, 3.5x. Premium but justified by margins and stability. Dividend yield, 2.4%. Attractive income component. Value assessment. While Morgan Stanley appears expensive using strict Graham criteria, the company's transformation, market position, and current business quality may justify premium valuations for long-term investors. Pros versus cons. The bull and bear cases for Morgan Stanley. The bull case. Why Morgan Stanley could continue outperforming. 1. Wealth management dominance. Morgan Stanley has built the premier wealth management franchise on Wall Street, with $7.9 trillion in client assets and over 16,000 financial advisors. The aging demographics and increasing wealth inequality create powerful tailwinds for this business, which generates stable, fee-based revenue with strong margins. 2. Market leadership position. The firm ranks among the top 3 investment banks globally, consistently leading in equity underwriting and maintaining strong positions in M&A advisory. This market position provides pricing power and access to the most lucrative transactions. 3. Integrated business model. The combination of wealth management stability and investment banking growth creates a powerful platform. Wealthy clients can access investment banking services, while corporate clients can utilize wealth management for their executives, creating cross-selling opportunities and client stickiness. 4. Strong capital generation. Morgan Stanley generates substantial free cash flow, supporting both growth investments and consistent capital returns to shareholders. The firm's ROTCE target of 17% plus demonstrates strong profitability expectations. 5. Digital transformation. The E*TRADE acquisition and ongoing technology investments position Morgan Stanley well for the digital wealth management future, particularly appealing to younger investors and mass affluent segments. The bear case. Why caution may be warranted. 1. Valuation concerns. At 17.7x trailing earnings and near all-time highs, much of the positive transformation story appears priced into the stock. Any disappointment in growth or market conditions could lead to significant multiple compression. 2. Market cycle dependency. Despite diversification efforts, Morgan Stanley remains exposed to market cycles. Investment banking revenues are particularly volatile, and wealth management assets are sensitive to market valuations, affecting fee income. 3. Competitive pressures. J.P. Morgan Chase has emerged as a stronger competitor in investment banking, while technology companies threaten traditional wealth management through robo-advisors and direct investing platforms. 4. Regulatory risks. Financial services companies face ongoing regulatory scrutiny. Changes in capital requirements, fiduciary standards, or trading regulations could impact profitability and business models. 5. Interest rate sensitivity. Rising interest rates can benefit net interest margins, but may hurt asset valuations and investment banking activity. Conversely, Falling rates can compress margins while supporting asset values, creating complex trade-offs. 6. Economic recession risk. A significant economic downturn could simultaneously hurt investment banking activity, reduce wealth management assets, and increase credit losses, creating a challenging operating environment. Important checks, controversies and market position, recent controversies and legal issues. Morgan Stanley has faced several significant controversies that investors should understand. 1. Block trading fraud, 2024. The SEC charged Morgan Stanley and former executive Pawan Passi with fraud involving confidential information about block trades. The firm agreed to pay more than $249 million to settle charges, representing one of the largest recent enforcement actions. 2. Racial discrimination lawsuits. Multiple lawsuits allege systemic racial discrimination, including claims that only 1% of Morgan Stanley's 18,000 financial advisors are Black, and that Black advisors are paid 30% less than white counterparts. These cases highlight ongoing diversity and inclusion challenges. 3. Data security issues. The firm was fined $60 million by the OCC for failing to properly secure customer data when decommissioning data centers, exposing personally identifiable information of approximately 15 million customers. 4. International legal challenges. Dutch prosecutors have charged Morgan Stanley with tax evasion related to the Cum-Ex scandal, seeking penalties for allegedly illegal dividend tax refund claims totaling $124 million. Global market position. Despite challenges, Morgan Stanley maintains strong competitive positions. Investment banking ranks among the top 3 globally, though JP Morgan has gained ground in M&A advisory fees. The firm remains particularly strong in technology and healthcare sector coverage. Wealth management, clear market leader in the high net worth segment with significantly more assets under management than competitors like UBS or Goldman Sachs. Trading and markets, strong equities franchise, though Goldman Sachs maintains advantages in fixed income trading. The firm's integrated model differentiates it from pure-play investment banks or wealth managers, creating unique value propositions for clients across segments. Conclusion. Weighing transformation, success against valuation concerns. After this comprehensive analysis, Morgan Stanley presents a compelling but complex investment case that embodies both the opportunities and challenges of modern financial services investing. The investment thesis. Morgan Stanley represents a rare Wall Street success story. 1. Successful transformation from volatile investment bank to diversified financial services leader. 2. Market-leading positions in wealth management and investment banking. 3. Strong financial metrics with consistent profitability and capital returns. 4. Experienced management with clear strategic vision and execution track record. The company has demonstrated remarkable resilience through various market cycles and has built sustainable competitive advantages in key growth markets. The valuation challenge. Traditional value metrics suggest Morgan Stanley may be fairly valued to slightly expensive at current levels. However, the company's transformation, market positions, and growth prospects may justify premium valuations for investors with longer time horizons. Risk-reward assessment. For income-focused investors, Morgan Stanley offers a solid 2.4% dividend yield with potential for growth as the company continues generating strong cash flows. For growth investors, the wealth management megatrend and continued market share gains in investment banking offer compelling long-term opportunities, though near-term returns may be more modest given current valuations. For value investors, the current price may warrant patience for a better entry point, though waiting for significant discounts on quality financial services, companies can require considerable patience. Investment suitability. Morgan Stanley appears most suitable for investors seeking exposure to wealth management and investment banking growth trends, quality financial services, franchise with strong market positions, reasonable dividend income with growth potential, long-term wealth creation through business transformation. The stock may be less appropriate for investors seeking deep value opportunities at significant discounts, high current dividend yields, stocks insulated from market cycle volatility. Morgan Stanley stands as one of Wall Street's greatest transformation success stories, evolving from a crisis-era survivor to a modern financial services powerhouse. While the stock may not offer explosive short-term returns at current valuations, it provides exposure to powerful long-term trends in wealth management and investment banking through a well-managed, market-leading franchise. The company's strong competitive positions, proven management team, and conservative balance sheet position it well for continued success. However, investors should be mindful of current valuation levels and consider Morgan Stanley as part of a diversified portfolio rather than a high-conviction standalone position. The firm's journey from near collapse in 2008 to today's market leadership demonstrates the power of strategic transformation and excellent execution. For patient investors willing to pay reasonable prices for quality, Morgan Stanley offers compelling exposure to the future of financial services. Important disclaimer: this analysis is provided for educational and informational purposes only and should not be considered personalized investment advice. All investments carry risk, including the potential for loss of principal. Past performance does not guarantee future results. The financial services industry faces unique regulatory, competitive, and economic risks that can significantly impact individual companies and their stock prices. Financial services stocks are particularly sensitive to interest rate changes, market conditions, and economic cycles. Before making any investment decisions, please consult with a qualified financial advisor who can assess your individual financial situation, risk tolerance, and investment objectives. Consider conducting your own research and due diligence, and never invest more than you can afford to lose. The author may or may not hold positions in the securities mentioned. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.